In this video, we're going to review the 12 best monthly dividend stocks and funds to buy in 2023. So before we start, please like this video and subscribe to our channel for weekly updates. Let's get started. For all the changes we've experienced in recent years, some things remain regrettably the same. We all have bills to pay, and those bills generally come monthly. Whether it's your mortgage, your car payment, or even your regular phone and utility bills, you're generally expected to pay every month. While we're in our working years, that's not necessarily a problem, as paychecks generally come every 2 weeks. And even for those in retirement, Social Security, and if you're lucky enough to have one, pension payments also come on a regular monthly schedule. But unfortunately, it doesn't work that way in our investment portfolios. That's where monthly dividend stocks come into play. Dividend-paying stocks generally pay quarterly, and most bonds pay semi-annually or twice per year. This has a way of making portfolio income lumpy, as dividend and interest payments often come in clusters. Monthly dividend stocks can help smooth out that income stream and better align your inflows with your outflows. We'd never recommend buying a stock purely because it has a monthly dividend, says Rachel Klinger, president of McCann Wealth Strategies, an investment advisor based in State College, Pennsylvania. But monthly dividend stocks can be a nice addition to a portfolio and can add a little regularity to an investor's income stream. Today we're going to look at 12 of the best monthly dividend stocks and funds to buy in 2023. You'll see some similarities across the selections. This is due to the fact that monthly dividend stocks are typically concentrated in a select group of industries, including closed-end funds, business development companies, BDCs, real estate investment trusts, REITs, and real estate. These sectors tend to be more income-focused than growth-focused and produce yields that are vastly higher than the market average. But in a market where the yield on the S&P 500 is currently 1.6%, that's certainly welcome. The list isn't particularly diversified, so it doesn't make a complete portfolio. In other words, you don't want to overload on monthly dividend stocks. But they do allow exposure to a handful of niche sectors that add some income stability, so take a look and see if any of these monthly payers align with your investment style. Let's review our list of the 12 best monthly dividend stocks and funds to buy in 2023. Number 12. Realty Income, ticker, O. Market value, $40.4 billion. Dividend yield, 4.4%. Perhaps no stock in history has been more closely associated with monthly dividends than Realty Income, a conservative triple net retail stock. As its official name, the company is trademarked as the monthly dividend company. Naturally, since Realty Income is a stock, the price of its shares can fluctuate just like that of any other stock. However, it's still the closest thing to a bond you can find on the stock market. Through its vast empire of more than 11,000 properties, which it rents out to more than 1,000 tenants, it generates a consistent rental income. Realty Income focuses on high-traffic retail properties that are usually safe from recessions and, perhaps more importantly, Amazon.com proof. Perhaps no business is completely free of the risk of competition from Amazon and other e-commerce titans, but Realty Income comes close. Its largest tenants include 7-Eleven, Walgreens Boots Alliance, FedEx, and Home Depot, among others. The pandemic hurt because the portfolio had a lot of exposure to gyms and movie theaters. Those dangers, however, are thankfully a thing of the past. At current prices, Realty Income yields 4.4%. That's not a monster windfall, but it's much more than both the broader market as well as 10-year treasuries, with the latter yielding 2.8%. It's not the raw yield we're looking for here, but rather income consistency and growth. As of November 2022, Realty Income has made 622 consecutive monthly dividend payments and has raised its dividend for 98 consecutive quarters, making it a proud member of the S&P 500 Dividend Aristocrats. Since going public in 1994, Realty Income has grown its dividend at a compound annual growth rate of 4.4%. While that's below the rate of inflation today, it's well ahead of inflation over the duration of that period. And regardless of whether the Fed manages to get inflation under control anytime soon, Realty Income's history suggests it should be able to keep its dividend growth rate ahead of inflation. Number 11. Stag Industrial, ticker, STAG. Market value, $5.8 billion. Dividend yield, 4.2%. Realty Income was pretty darn close to being Amazon.com proof. But fellow monthly payer Stag Industrial proactively benefits from the rise of internet e-commerce. Stag invests in logistics and light industrial properties. You know those gritty warehouse properties you might see near the airport with 18-wheelers constantly coming and going? That's exactly the kind of property that Stag Industrial buys and holds. E-commerce is growing by leaps and bounds, which is a given, and Stag is set up to take advantage of this. About 40% of Stag Industrial's business is related to e-commerce in some way, and Amazon.com is its biggest tenant. E-commerce spiked during the pandemic for obvious reasons. As stores have reopened, the effects of that spike have dissipated somewhat, but the trend here is clear. We're making a larger percentage of our purchases online, and that trend only goes one way. Also, there are a lot of different logistics companies, and Stag's management thinks their market is worth around $1 trillion. Yet there's still plenty of room for growth. As crazy as this might sound, fewer than 14% of retail sales are made online, according to the US Census Bureau. Stag Industrial isn't sexy, but it's one of the best monthly dividend stocks to buy in 2023, with a long road of growth ahead of it. And its 4% plus yield is competitive in this market. Number 10. Gladstone Commercial, ticker, GOOD. Market value, $730.8 million. Dividend yield, 7.4%. For another gritty industrial story, consider the shares of Gladstone Commercial. Gladstone Commercial, like Stag, has a large portfolio of logistical and light industrial properties. Approximately 51% of its rental revenues come from industrial properties, with another 45% coming from office real estate. The remaining 4% is split between retail properties and medical offices. It is a diversified portfolio that has done well through the crazy volatility of the past few years. As of May 2022, the REIT had a portfolio of 131 properties spread across 27 states and leased to 110 distinct tenants. Since 2012, the REIT has grown its portfolio by 15% each year in a steady planned way. Its occupancy stands at 97.0% and has never dipped below 95.0%. That's not a bad run. Gladstone Commercial is also one of the companies that have paid a dividend every month since January 2005, without fail. It currently yields a juicy 7% plus. Number 9. EPR Properties, ticker, EPR. Market value, $3.8 billion. Dividend yield, 6.6%. The COVID-19 pandemic was rough on a lot of landlords. But few are as uniquely battered as EPR Properties. EPR owns a diverse and eclectic portfolio of movie theaters, amusement parks, ski parks, eat and play properties like Topgolf, and a host of others. EPR specializes in experiences over things, which is just about the worst way to be positioned at a time when social distancing was the norm. Almost every property EPR owned was closed for an extended period of time, and crowds have yet to return to pre-COVID levels across much of the portfolio. But the key here is that the worst is behind EPR Properties, and the more normal life becomes, the better the outlook for EPR's tenants. EPR was a consistent dividend payer and raiser before the pandemic. But because its tenants were going through a crisis of existence, the REIT got rid of its dividend in 2020. Since business is doing much better in 2021, EPR brought back its monthly dividend in July, and each share now pays out 6.6%. If you believe in life after COVID, EPR is one of the best monthly dividend stocks to play. Number 8. LTC Properties, ticker, LTC. Market value, $1.5 billion. Dividend yield, 6.1%. For one final traditional REIT, consider the shares of LTC Properties. Short-term problems are still being caused by the pandemic, but the outlook for LTC is good in the long run. LTC is a REIT with a portfolio roughly split equally between senior living properties and skilled nursing facilities. Needless to say, COVID-19 was hard on this sector. Outbreaks were more likely to happen in nursing homes, and because of their age, the people who lived there were at a higher risk. Senior living properties are different because most of the people who live there are younger and don't need medical care. But a lot of would-be tenants were reluctant to move out of their homes and into a more densely populated building during a raging pandemic. These lingering effects won't disappear tomorrow. But in the end, senior living facilities still give many seniors a nice and active way of life that hasn't changed much. And some seniors who need skilled nursing might be able to get care at home. Ultimately, there comes a point where there are few alternatives to the care of a nursing home. Importantly, the longer-term demographic trends here are all but unstoppable. The peak of the baby boomer generation is in its early to mid-60s today, far too young to need long-term care. But over the next 2 decades, demand will continue to build as more and more baby boomers age into the proper age bracket for these services. At 6% plus, LTC is one of the higher-yielding monthly dividend stocks on this list. Number 7. AGNC Investment, ticker, AGNC. Market value, $6.1 billion. Dividend yield, 11.9%. AGNC Investment is a REIT that is very different from the likes of Realty Income, Stag or any of the others covered on this list of monthly dividend stocks. Rather than own properties, AGNC owns a portfolio of mortgage securities. This gives it the same tax benefits as a REIT with no federal income taxes so long as the company distributes at least 90% of its net income as dividends, but a very different return profile. Mortgage REITs are designed to be income vehicles, with capital gains not much of a priority. As such, they tend to be monster yielders. Case in point, AGNC yields 11.6%. There's a reason for that. AGNC only invests in mortgage-backed securities issued by Fannie Mae, Freddie Mac, Ginnie Mae, or the Federal Home Loan Banks. These include bonds and other types of securities. This makes it one of the safest plays in this space. And here's a nice kicker, AGNC almost always trades at a premium to book value, which makes sense. You and I lack the capacity to replicate what AGNC does in-house and lack access to financing on the same terms. Those benefits have value, which shows up in a premium share price. Yet today, AGNC trades at a 15% discount to book value. That's a fantastic price for a stock in this space. Number 6. Dynex Capital, ticker, DX. Market value, $587.6 million. Dividend yield, 9.6%. Along the same lines, let's look at Dynex Capital. Like AGNC, Dynex is a mortgage REIT, though its portfolio is a little more diverse. Just over 90% of its portfolio is invested in agency residential mortgage-backed securities bonds made out of the mortgages of ordinary Americans, but it also has exposure to commercial mortgage-backed securities and a small allocation to non-agency securities. It's important to remember that the mortgage REIT sector was eviscerated by the COVID-19 bear market. When the world first went into lockdown, it wasn't immediately clear that millions of Americans would be able to continue paying their mortgages, which led investors to sell first and ask questions later. In the bloodbath that followed, many mortgage REITs took catastrophic losses, and some failed altogether. Dynex is one of the survivors. And frankly, any mortgage REIT that could survive the upheaval of 2020 can likely survive the apocalypse. Your risk of ruin should be very modest here. Dynex trades at a 12% discount to book value and sports a juicy yield of nearly 10%. We could see some more volatility in the space as the Federal Reserve continues to push rates higher, but for now, this looks like one of the best monthly dividend stocks to buy if you're looking for a seriously high yield. Number 5. Broadmark Realty, ticker, BRMK. $948.2 million in market value. Yield on dividends, 11.3%. As it doesn't own mortgages, Broadmark Realty isn't a mortgage REIT per se. But it performs a comparable action. A portfolio of deed of trust loans that are used to finance real estate investment or development is managed by Broadmark. This is a little different than AGNC or Dynex. These mortgage REITs primarily trade standardized mortgage-backed securities. Broadmark instead deals with the less liquid world of construction loans. Still, BRMK runs a conservative book. The weighted average loan-to-value of its portfolio is a very modest 60%. In other words, Broadmark would lend no more than $60,000 for a property valued at $100,000. This gives the company a wide margin of error in the event of a default by a borrower. At current prices, Broadmark yields an attractive 11.3% and trades at a 16% discount to book value. The company started paying a monthly dividend at the end of 2019 and had no major problems during the pandemic. Number 4. Main Street Capital, ticker, MAIN. The market is worth $2.7 billion. 6.6% dividend yield. We know that the pandemic hit Main Street a lot harder than Wall Street. It is what it is. But what about business development companies? This is where the proverbial Main Street means the proverbial Wall Street. BDCs provide debt and equity capital mostly to middle market companies. These are entities that have gotten a little bit of financing from bank loans and retained earnings but aren't quite big enough yet to warrant an initial public offering. BDCs exist to bridge that gap. The appropriately named Main Street Capital is a best-in-class BDC based in Houston, Texas. The last 2 years were not particularly easy for Main Street's portfolio companies, as many smaller firms were less able to navigate the lockdowns. But the company persevered, and by late 2021, its share price had climbed back above pre-pandemic highs. Main Street's monthly dividend plan is conservative because it pays out a small dividend each month and then uses any extra money to give out special dividends twice a year. This keeps Main Street out of trouble and keeps it from having to cut its dividends in years when earnings may be temporarily low. As far as monthly dividend stocks go, Main Street's regular payout works out to a respectable 6.6%, and this does not include the special dividends. Number 3. Prospect Capital, ticker, PSEC. $3 billion in market value. 9.2% dividend yield. For another high-yielding, monthly paying BDC, consider the shares of Prospect Capital. Like most BDCs, Prospect Capital provides debt and equity financing to middle-market companies. The company has been publicly traded since 2004, so it has proven to be a survivor in what has been a wildly volatile 2 decades. Prospect Capital is objectively cheap, as it trades at just 71% of book value. Book value itself can be somewhat subjective. However, the nearly 30% margin gives us some leeway. It's safe to say the company, even under conservative assumptions, is selling for less than the value of its underlying portfolio. It also yields a very healthy 9% plus. As a general rule, insider buying is a good sign. When the management team is using its own money to buy shares, that shows a commitment to the company and an alignment of interests. Over the past 2 years, the management team bought more than 29 million PSEC shares combined. These weren't stock options or executive stock grants. These are shares that the insiders bought themselves in their brokerage accounts. Number 2. Ecofin Sustainable and Social Impact Term Fund, ticker, TEAF. Assets under management, $250.81 million. The fund has a 7.4% distribution rate. The fund's expense ratio is 2.33%. There's something to be said for orphan stocks. Some certain stocks or funds simply don't have a normal go-to buying clientele. As a case in point, consider the Ecofin Sustainable and Social Impact Term Fund. This is a closed-end fund that straddles the divide between traditional energy infrastructure, such as pipelines, and green energy projects, such as solar panels. Additionally, it makes investments in social impact industries like senior living and education. About 65% of the portfolio was allocated to sustainable infrastructure as of March 2022. Infrastructure for energy and investments with a social impact took up 17% and 18% of the portfolio, respectively. But this isn't the only way the fund is eclectic. It's also a unique mixture of public and private investments. 51% is in publicly traded stocks, and the other 49% is in private companies that are not traded. This lack of obvious buyers helps explain why the fund trades at a large discount to its net asset value of 15%. In other words, you can effectively buy TEAF's holdings for 85 cents on the dollar. In about 10 years, the fund will come to an end, which means that the assets will be sold and the money will be given back to the investors. Buying and holding this position at a deep discount would seem like a no-brainer of a strategy. Number 1. BlackRock Municipal 2030 Target Term, ticker, BTT. Assets under management, $2.62 billion. The fund's distribution rate is 3.3%. The fund has a 1.1% expense ratio. The BlackRock Municipal 2030 Target. As its name suggests, the fund is designed to be liquidated in 2030. But buying a portfolio of safe municipal bonds trading at a discount to net asset value would seem like a smart move. The biggest selling point of muni bonds is, of course, the tax-free income. The bond interest isn't subject to federal income taxes. And while city, state and local bonds aren't risk-free, only the US government can make that claim. Defaults and financial distress in this space are rare. So you're getting a reasonably safe, tax-free payout. As of May 2022, BTT's portfolio was spread across 639 holdings, with its largest holding accounting for about 3.6%. BTT sports a distribution rate of 3.3%. That's not high yield by any stretch of the imagination. But remember, the payout is tax-free, and if you're in the 37% tax bracket, your tax equivalent yield is a much more palatable 5.2%. This concludes our list of the 12 best monthly dividend stocks and funds to buy in 2023. Which of these stocks would you like to include in your portfolio of investments? Comment below and let us know. Don't forget to like this video and subscribe to our channel for weekly updates on the best stocks to buy and cutting-edge investment strategies. Thank you for watching, and best of luck with your investments.